Welcome and thank you for participating in the Fiduciary Self-Audits for Nonprofits Evaluating Decision-Making Processes and Controls webinar. We apologize for the technical difficulties during the introduction to this webinar. The following recording is the full meeting recording without the introduction.
Better understanding their roles and responsibilities and how to discharge their roles and responsibilities and document their roles and responsibilities. So I have to say, we have probably been doing this program in some shape or form for the last 3 years, and it really is amazing to me that even today, as everything continues to evolve, we have such a great crowd here live, and we have such a great crowd in the audience. So we really appreciate you guys coming out. As you might imagine, so I'm going to focus primarily over the next 20 or 25 minutes on the investment function, the investment side, but a lot of the fiduciary responsibilities that we talk about in conjunction with the investment function really should be more generally applied to other functions in the organization, whether it be accounting, whether it be the investment side, whether it be the expenditure side, whether it be engaging service providers in the non-investment world. So you have many of the same fiduciary responsibilities. You should think about the documentation. You should think about the audit process in much the same way. And next month, if you guys listen in on that presentation, you're going to hear a lot of the same things. I think is it Widge who's doing it, Jeff? I don't know if Widge Devaney is one of our partners in New York. He'll give you a little bit more of a different flavor from the enforcement side, which I think is always brings everything to life. So starting out with the investment side, these are some of our objectives right off the bat. We want to understand some of the key provisions of the Uniform Prudent Management of Institutional Funds Act, discover components of an effective and disciplined investment process, and if time permits, we'll talk a little bit about finding out about different ways to approach underwater endowment options. Like I said, we started this program when I came in 2008. It was predicated upon the adoption by the National Conference of Commissioners of Uniform State Laws of UPMIFA, which is the Uniform Prudent Management of Institutional Funds Act. As I said, it was enacted in 2006. It continues to be adopted in virtually all states, and now 49 plus the district, in some form or another. But the laws keep evolving. Interpretations by state attorney generals continue to evolve as well, and I think over time to continue to follow it, it's a pretty interesting topic, and to better understand what you could do going forward. You could look at other jurisdictions like New York, where they have a long report issued by the attorney general, where they've given additional considerations other than those of UPMIFA. They also have other ways to approach donors as well, to think about different ways to go beyond the minimum legal requirements in your particular jurisdiction. So the key implications of UPMIFA, it modernizes the rules governing appropriations and endowment spending rules. So in general, what it does is it lifts the historical cost floor and allows you to spend below the endowment principle, and we'll get into a little bit more into that later. It provides greater flexibility and guidance in connection with the investment management function, and it provides greater flexibility in releasing donor restrictions on institutional funds. It applies to all institutions as defined by UPMIFA. I don't want to read the chart, and you have in your book, but you'll see how institutions are defined here. It applies to not-profit corporations and wholly charitable trusts where the trustee is a non-profit corporation. And we give you some examples here of the types of Section 501 organizations that would be applicable. Many of the rules apply specifically to endowments created by third parties, not the institution. And what's important here is that the institution has its own institutional funds and sets up an account and implements its own restrictions. Many of the considerations of UPMIFA do not specifically apply to that account, but if I, Rory Cohen, give $10 million to a university for scholarships, okay, and I've set up an endowment through a particular gift instrument, it will apply to that particular, to the investment, the management, and the expenditure of those funds. Start out real quickly, and you've probably heard this time and time again. Generally speaking, you have a duty of loyalty and a duty of care. And a duty of loyalty means that in the context of an endowment, you need to put the best interest of the organization first. The duty of care means you basically have to act with reasonable care with a person in a like situation and like expertise in that particular situation. I look at the duty of care on the investment side, and there are a number of sort of components underneath it, and I want to come back to it. But generally speaking, and UPMIFA makes them a little bit more explicit, and we'll come back to it, you generally have a duty to investigate, you have a duty to diversify, you have a duty to dispose of unsuitable assets, and those all fall under the duty of care. Okay, so as a duty of care, in acting like a reasonably prudent person, okay, you're not a guarantor. So on the investment side, the investment function, nothing's going to go right all the time. And the investment function, even today, becomes far more complicated than it ever had been. We're in a situation where you're seeing far greater volatility than we've ever seen in the past. You're seeing many different investment options than we've ever seen in the past. So it used to be, I just allocate my investments to equities, fixed income, maybe a little real estate, but other than that, there really weren't a lot of alternative assets to think about. Today, we have mutual funds, we have exchange-traded funds, we have hedge funds, we have private equity funds, we have commodity funds, we have alternative asset classes like life settlements, gold, different types of commodities. So the amount of investment options that are available to organizations is far broader than it ever had been, which brings their own complexities and makes it much more further complex to understand the correlations among the asset classes, the performance of the asset classes, to do due diligence of the underlying investment product than ever before. So we get questions, and now it's finally working, we get questions from a number of different nonprofits about whether or not they can invest in certain asset classes and what kind of due diligence they need to do in connection with particular asset classes. And I think Rob will talk a little bit about that. We'll talk about the investment policy statement. But in terms of setting up some sort of auditable function, it does help at the outset to have some sort of roadmap, which is the investment policy statement, which we're going to get into in a little bit. So we set up, here are some of the considerations for being a prudent investor. As mentioned previously, you need to exercise reasonable care, skill, and caution. You need to take a portfolio approach. Historically, years ago, people used to look at everything on an investment-by-investment basis rather than a portfolio approach. And I think what's different between UPMIFA than its predecessor, UMIFA, was it makes explicitly clear and acceptable the fact that you'll use modern portfolio theory and consider how adding an investment or subtracting investments can impact the overall expected rate of return of the underlying portfolio. So it's going to add risk or subtract risk from the portfolio. It's going to add an expected rate of return or subtract an expected rate of return. You need to think about that in the context of what your spending policy might be in designing your portfolio. Reasonable skill, care, and caution really is dependent upon your own background. So if you're a financial expert, the Attorney General is going to basically hold you to a higher degree of a higher standard than if you didn't have a financial background. So, the board has to give consideration as to who they're going to put on the investment committee. It is helpful to have someone who's an accountant. It is helpful to have someone who has an investment background. It is helpful to have someone who, understands investments, who can advise you. Because we'll get to later, you really have to understand what you're investing in. You can't simply just give away your fiduciary responsibility to a third party. You have to have confidence that, they know what they're doing. You have to be able to evaluate them and to understand that they know what they're talking about. So if you're a financial expert, okay, if you understand balance sheets, if you understand 10Ks and other financial statements, there's going to be a greater burden on you to participate in that function than if you were a layperson or if you were just an operating person or if you were just an industry person and you really had the financial acumen that someone else had. You need to exercise prudence under the facts and circumstances prevailing at the time of the action or decision. You need to consider the organization's risk and return objectives as well. So what we talk about, if your spending policy requires that or anticipates that you may spend 5% a year, 7% a year, in setting up your investment policy, you have to think about how am I going to get there? What kind of investments should I consider? What kind of investments are going to give me that rate of return and provide proper diversification so I don't have too much volatility in my portfolio where I can have an expected rate of return to help support that spending policy over time. So the two are really closely tied together, and you have to take that into consideration. And you have to exercise prudence under the facts and circumstances prevailing under the time of the action or decision. So let's say, for instance, you were going to invest in alternative in a hedge fund, okay, and you're going to get the underlying documentation for the hedge fund. Okay, at that particular time, okay, what would be prudent would be for, and what often happens when you use consultants, some consultants assume full discretion. Some consultants don't assume full discretion, and they just provide consulting non-discretionary advice and recommendations. In the facts and circumstances in that case, what kind of documents can I have access to, right? What kind of transparency does that asset manager provide? What kind of information do I have about the fund itself, the manager itself, the principles of the manager itself, the performance of the managers itself? how much information can I get? Where things aren't transparent, where they're opaque, and you really just have no idea what the manager's doing, okay, that might suggest that perhaps you shouldn't invest in that investment. If you have a lot of information, it's very transparent, you have portfolio level transparency, it would behoove you to be actually prudent to actually get a sense of whether or not go a little bit further and to say, how have they described their investment process? Are these investments consistent with that investment process? Are they deviating from this investment process? How often should I evaluate that manager? Do they give the information monthly, quarterly, semi-annually, annually? So you continue to stay on top of the due diligence to try to get ahead of things if the manager is deviating from their strategy or performance is too volatile, far more volatile than you had otherwise anticipated or they had otherwise suggested it might be. You have a duty to minimize costs. That was another one I wanted to highlight. Again, in the context of hiring a third party. I mean, you have nonprofits of all different sizes. There are some nonprofits which are very large, which have investment teams of their own. Okay, they may just hire people like investment consultants for information that they use with other information they get from other sources. And what's ironic in that situation is the larger organizations probably have the most money to spend on outside consultants. The smaller organizations have the least money, no internal staff to spend on consultants. So that creates challenges in connection with the investment function. So what do you do in that situation? I was at a conference 2.5 years ago in California, and someone from the nonprofit said to me, well, what if we wanted to invest in alternatives? And we want to invest in hedge funds. We want to add hedge funds to our portfolio. Everybody's doing it. And we said, well, what do you know about alternative investments? And he said, well, we don't know anything internally about alternative investments, but everyone tells us it gives us a better risk-adjusted return because hedge fund managers can short markets in a down market, and they can go long in a favorable market. So we think we should have it as part of our portfolio. And we said, well, if you were to read the underlying offering document, could you understand it? And they were like, no. And we said, well, then you'd have to hire an outside consultant. And he said, well, we don't have resources to hire an outside consultant. So the answer in that situation was, well, you cannot invest in alternative investments. So it seems kind of straightforward and basic, but you sort of have this mindset where people want to move with the herd and they want to invest where everyone's investing, and they read a little bit in the Wall Street Journal and they read a little bit with the New York Times about the kind of investment they should add to their portfolio, but you really have to have a strong fundamental understanding of what it is you're investing in order to even put it into your portfolio. The second thing I want to highlight in connection with the use of consultants, when you have non-discretionary consultants, some consultants you'll give discretion to, they'll sign the offering documents, they'll undertake the fiduciary responsibility for that investment. Some may not. They'll say, well, we recommend this investment. Here's the offering document. Here's the subscription document. Here's their pitch materials. Here's their performance composites. Review this. Okay, when you sign the subscription document of the underlying fund on behalf of the organization, you're assigning, if you haven't given discretion to a third party, that you, being a person of authority of that nonprofit, fully understand and comprehend the offering document. You understand the merits of the investment and the risks of the investment. You have had an opportunity, or maybe the consultant's been able to get information for you, to sit down with the general partner, the managing member of the fund, and ask them as many questions as you want to better understand the product. You make representations regarding the liquidity of your portfolio. You make representations regarding your need for capital. You make representations that say you may lose everything with this investment. Okay? Somebody on your board or the investment committee, if they're delegated that authority, needs to understand what they're reading in that context so they can make those representations. Because I can tell you, if something goes wrong, you're going to look to the consultant and they're going to have protection. If something goes wrong, you're going to look to the fund manager and they're going to pull out a 15-page subscription agreement that says, see what you said to me here. So you guys have to have the wherewithal. You need to have the level of sophistication. You need to have the sort of investment acumen to understand if you're going to invest in those kinds of securities. So you talk about the size of the assets, the purpose of the institution, the skill sophistication of the investment committee, and the third-party advisor cost should be reasonable. One of the other prudent processes that you should have is when you engage a third-party manager or advisor, you should be able to assess the reasonableness of their fees. So you need to think about the type of services they're providing, the level of their fees. It's good practice to have an RFP so you can compare apples to apples to get a sense of what services are being provided by either that investment manager or that consultant and the fees that they're providing so that you can compare them against another consultant or another investment manager. So if the Attorney General comes knocking, or if a large donor-to-do organization says, hey, I think you're wasting assets here, you can come back and you can justify the fact that we have considered what the costs are relative to other investment options, relative to other investment managers, relative to other investment consultants.
Can I ask a question? So obviously you're talking about a portfolio with regard to the nonprofits endowment primarily.
Right.
But with regard to at least the investment options, are these principles similar for the fiduciary responsibilities under ERISA defined contribution plan?
Well, for ERISA,
You got to repeat the question.
okay, I think the question was basically, are these principles similar to principles under ERISA on defined contribution plans? Okay, and that's a very good question, because you look, people always say to me, well, where's the risk? Are there enforcement actions being brought? And I think in the context of defined contribution plans, when you're looking at ERISA, you've seen far more, at least from what I've seen, far more active enforcement from the DOL, or far more lawsuits on the part of constituents of the ERISA plan, okay, that are alleging that the fiduciaries to that plan aren't adequately discharging their fiduciary responsibilities. So under ERISA, okay, versus this, okay, the standard here is to be a reasonably prudent person. Under ERISA, okay, you're an expert. Okay, so it's a much higher standard under ERISA. Okay, under ERISA, okay, there are very specific prohibitions against any self-dealing at all with the plan. Okay, in the typical non-ERISA type of nonprofit, it's possible you may have certain transactions with affiliated parties if your conflicts of interest policy contemplates it, and if you have adequate controls. And I think it's prudent in that situation, if there were to be an arrangement with a potential affiliate or some other arrangement where there might be an actual potential conflict of interest, that the person who is conflicted recuses themselves from the vote. So it would be fully disclosed and then recuses themselves from the vote, so that anyone else on the board or anyone else on the investment committee who's making the decision, okay, would make a reasonably informed decision and wouldn't be overly influenced by any other party on the board. Now with ERISA, straight prohibitions on self-dealing. But on the ERISA side, there are a number of cases out there where people are looking at wasting of assets, okay, spending too much money to engage third parties, whether it be administrators or putting investment options on the plan that are conflicted. So to answer your question, the standards are different, but in the world of ERISA, you're seeing far more litigation.
And higher for ERISA.
Well, the standard is higher for ERISA. So the expectation is you're an expert in ERISA versus just a reasonable person. But I used to discuss this with my ERISA counterpart for a while. There really have been a lot of cases defining what it means to be an expert. It's just accepted that it's something higher than a reasonably prudent person. No, we can try to go back to our ERISA partner and ask him again. But I remember having that conversation with him, I don't know, maybe about a year ago again, because it comes up from time to time. People say, what do I need to do to be an expert? But at the end of the day, and we'll get into some of the considerations, for me, and I think under ERISA, it would go a long way to protecting yourselves when you look at the process, and you look at how you substantiate the process and document the process and document your considerations. So you create an audit trail to show that you were reasonable and to show that you looked at important critical factors to protect yourself from that perspective. Under UPMIFA, and again, this is just a uniform statute. The states have adopted it in some form or another. In managing the fund, in making investment decisions, these are the considerations that are set forth under the uniform statute. Virtually all states have adopted something substantially similar. So you need to think about the general economic conditions, the possible effects of inflation and deflation, the expected tax consequences of the investment decisions, the role that each investment or course of action plays in the overall investment portfolio. So that's the modern portfolio theory that we talked about before. The expected return from income and the appreciation of investments, other resources of the institution. So just to talk briefly about this, where you're talking about tying in your spending policy to your investment policy, okay, and you're thinking about what level of return do I need for investments to help support that rate of return of, let's say, 7% arbitrarily each year. Okay, you may not need to generate 7 or 8 or 9% from your investments if your fundraising activities year in, year out are providing you additional resources. So you might be able to accept a lower rate of return from your investment portfolio with certain assumptions built in about where money might be raised from other parts of your fundraising efforts. the needs of the institution and the fund to make distributions to preserve capital, and the asset special relationship or special value, if any, to the charitable purposes. So those are some of the factors that you need to consider. So when you talk about delegation of external agents, I'm going to come back to this because I want to get to some. This seems to be of importance to you, and it seems to be important to a lot of our clients in particular now, which is how do I protect myself? How do I demonstrate that I acted reasonably? How do I go a long way toward proving that I was an expert in consideration of my investment portfolio? And this gets to the heart of why it's so relevant to have a written investment policy statement. The investment policy statement helps you think through. It helps the board. It helps the committee, the investment committee, to whom the responsibility is delegated. Think through your spending policies. Think through investment risk. Think through asset classes. Think through implementation, and think through review. And this is your whole roadmap. This is your whole roadmap. So when you go back and you talk about self-audits, and you talk about your process, and you talk about justifying your actions, this investment policy statement is probably the most indispensable tool you can have. It's a living and breathing document. Okay, you should be thinking of it. It may change over time, but it really sets forth your roadmap. It starts out with what's our investment objective? How much money do we need to raise? What's our rate of return in connection with the purpose of the organization and our expected expenditures year in and year out? When you start with that, then you have to think about, well, how do I generate that rate of return? Well, what asset classes do I have? And you probably talk to someone, like Rob, okay, and his group, okay, and they're going to say, well, this is how we think you, organization, depending on your expected rate of return and your appetite for risk and your investment time horizon, this is the kind of asset allocation we might recommend for you. And they'll give you a little pie chart, and they'll say, here's equity, fixed income, alternative investments, real estate, commodities, and you name it. And those are your asset classes. Then you move from your asset classes, and you talk about what kinds of investments should we use. Should we use mutual funds? Should we use ETFs? What are the costs between mutual funds and ETFs, which give me a better rate of return? Should we use separate account managers? Well, that goes to the size of the organization and whether or not you can actually access some of the separate account managers, which often have investment minimums for their portfolios. Should you use investment managers? Should you use hedge funds, private equity funds? Should you buy commodities directly themselves, or should you buy ETFs that give you a direct exposure to commodities? Okay, these are all considerations. That's your next layer. So you set your asset class, you think about your investment implementation, you think about whether or not you're adequately diversified, and here's your expected rate of return, and here's your expected level of risk, here's your anticipated liquidity of your portfolio, and this is how we're going to support our expenditures year in and year out. And once you figure that out, then you have to figure out, well, now how do I go about reviewing the success of this investment policy statement? And they'll talk to you about how often you should review it. So if you were to engage someone like Rob, you'd probably talk to him every 3 months or 6 months or 1 year, and they'll prepare a summary of what your portfolio has done over the last 3 months, 6 months, or 12 months. And they'll show you the performance of each underlying asset class. And they'll probably do some analysis on whether or not the manager is deviating from their style or strategy that they've defined for you. And that'll help you now monitor the effectiveness of the investment selection and the implementation of your investment policies. But you set it out in your investment policy statement. And what's important is you'll save yourself, based on how many people you have on your committee and how often they can meet, whether or not you want to review it every 3 months, 6 months, 9 months, or 12 months. You'll set out how you would, whether or not you would look at managers on an absolute basis, which is to say, do they make money in all situations, or whether or not you're going to look at them on a relative basis. So if you engage a large cap equity manager, I'm going to look at them versus the S&P 500 universe to see whether or not they're outperforming the overall market or other S&P managers. And fixed income the same. You'll pick some index. But you'll establish in your investment policy statement a roadmap for evaluating the different managers. You might also establish, okay, different triggers of immediate ad hoc review. So if my portfolio comes down a certain amount in a certain time period, like it drops 25% in 3 months, we're going to call Rob in immediately and say, let's talk and what's going on. I want to see where is this performance attributed to? Is it one hedge fund? Is it one segment of my asset allocation? Or whatever. But you're going to set out the roadmap for the frequency of your review. You might set forth specific instances where managers or funds should be either sold or terminated. Very specific instances. It might be helpful. The point being that when you go back, as long as you set out a reasonably thoughtful approach, and as long as you follow your policies, and you consistently apply your policies, then you have a very strong case that you acted very prudently, okay? That's why when we talk about the self-audits, it's critical to have this written document to go back, if you're the investment committee, to do some periodic reviews, to make periodic adjustments when necessary. When making investments and when changing investments, it's also very helpful to actually document your reasons for making that investment. So if you're going to invest in a hedge fund or invest in an ETF, or you're going to invest in real estate, and you've met with your consultant or the investment committee has considered each of the considerations set forth in the statute or other considerations, it's very useful to create minutes of that meeting. My view is the minutes should be, we don't have to go word for word, it's not a transcript of everything that transpired during the meeting, but it's useful to the extent questions are raised, to identify that certain questions were raised and they were discussed. If some follow-up information was requested and the investment was delayed pending that information, that's useful to put down because it shows some level of deliberation. It shows some degree of carefulness in considering the information. It shows that people aren't just signing off every day on everything. And so it's useful to actually document that and to show it, to retain it in the file. So if anyone ever comes in on audit and questions you, you can say, listen, we knew what we were investing in. We read the offering document, or we understood the impact of the asset allocation, and we spoke with Rob and his team every 3 to 6 months, and here's the report that they prepared for us, and we met for 2 hours on, you name the day every quarter to go over it. That's very useful from an auditing process to show that you exercised reasonable care and you sufficiently discharged your duty of care. So I put here just, basically, these are the questions that you need to ask yourself on the investment side. Do you know what you're buying? Who is managing the money? And how are they selected? And, this goes at the end of the day. I mean, there's some learning principles by what happened with Madoff now. I think at the end of the day, you really need to know who's managing your money. So if you're buying, a lot of people will invest in fund-of-funds because they think it's a convenient vehicle to get sufficient diversification to multiple investment vehicles. But at the end of the day, it's very useful to know, okay, you're just making allocations, but who's investing? And how were they selected? What's your process? And I put down here some very specific due diligence considerations, and one of our other presentations online goes into far greater due diligence considerations from a regulatory standpoint, from an operations standpoint, from a legal standpoint, in doing due diligence of underlying managers. So we sort of talked a lot about these. I'm not going to go into much detail. We talked about substantiation, documenting your portfolio level allocations, talked about the timing of review and analysis, the detail of the review of the analysis, preparing written summaries, et cetera. So I'm going to stop here because now we get to spending consideration. So with that, I'm going to pass it over to Rob.
Terrific. Thank you, Rory, and good afternoon to everyone that's here and also joining with us on the conference call today. I'm Rob Olcott, Managing Partner of Orion Investment Advisors. Some of you either in the room or perhaps joining us on the webinar today may also know that I'm the Managing Partner of the Olcott Consulting Group, which is the parent company of Orion Investment Advisors. Orion is our RIA, Registered Investment Advisory Firm, registered with the Securities and Exchange Commission. I'd like to, again, I think Rory did really a terrific job of providing an overview of this whole issue of fiduciary responsibility, tying it down to MIFA, which is the most recent act that fiduciaries are paying attention to. One thing that I guess I would like to clarify, and we get this question periodically, some of you may be affiliated with 501c6 organizations, and while MIFA specifically addresses charitable, it's really designed primarily for the charitable, the C3 organizations. The question is, does it really apply if I'm a 501c6? Well, I think our response to that would be that this is a little bit like Sarbanes-Oxley. When Sarbanes-Oxley was promulgated, it applied to the corporate world, but within a very short time, the principles and the practices of Sarbanes-Oxley began to trickle down into the nonprofit community, where they soon became best practices. And while Sarbanes-Oxley today does not apply to most of the provisions don't apply to nonprofit organizations, I think we'd all agree that the general provisions, the principles of Sarbanes-Oxley are in place today and do have become best practice. The question, just go back to the question also about the similarities between ERISA and MIFA, and I would concur. I mean, obviously the standards of ERISA have been around for a longer period of time than they have for those standards that relate to the management of charitable funds, although the basis of both the ERISA and of the charitable or of the MIFA all go back to really, I think, the prudent person principles, and then they started to digress, and ERISA became more specific. But as Rory indicated, it's all about a couple things. It's about, you know, all of you, whether you're a fiduciary or for your retirement plan or for endowment or your reserve funds, you need to be aware of the applicable and pertinent rules and regulations. You need to make sure you're complying with those rules and regulations. The second step is that you need to make sure that there's a process in place. Rory did a great job of talking about the importance of the process. There has to be a sound process in place that says, here's how we're going to make decisions, here's how we're going to evaluate results. You have to document that process. You have to document the meetings. You have to document your actions. And then finally, you know, you obviously have to be implementing according to the game plan, which in most instances for you will be your investment policy statements. I'm going to talk for just a few minutes, and my colleague Kenny Lowe is going to get up and talk also about a tool developed by a group called FI360. FI360 has been around for many years. They've developed a thank you, Jeff. They've developed a which is the down? Okay. FI360 has developed a template for what's called a fiduciary self-audit. This is a template that you can use and apply for your own organizations. You can implement it yourself, or it can be implemented in conjunction with an outside advisor. And it gets fairly detailed. We don't have time to get into all of the weeds with regard to the FI360 self-audit. But what we wanted to do today was give you some idea of a template, a process that is in place, a tool you can use to actually help you fulfill your responsibilities as fiduciaries, both on the ERISA side and on the non-ERISA side as well. So again, just by way of housekeeping before we get started, I think it's important, and Rory touched on this briefly, by way of nomenclature, there are sort of three types of fiduciaries when it comes to the investment world. You've got the investment steward. Those would be anyone that has fiduciary responsibility, the board, staff, your advisors, anyone that has a hand in the decision-making process. The investment advisor, as Rory indicated, is typically a person that's responsible for providing advice or counsel to your organization with regard to your plan or regard to your fund. And then finally, the investment manager. In our definition, typically, the investment manager is the entity that is actually making the day-to-day decisions about which securities to buy and sell. It could be a mutual fund. It could be a separately managed account. It could be an exchange-traded fund. But today, and we're seeing this more and more often in our practice, organizations are turning to their investment advisors and providing them with the discretion to select the mutual funds or to select the separately managed accounts. We see this happening. It's been happening for several years among the larger funds, and we see this as a trend that is increasing, where an organization will decide that or you have the investment committee or the budget and finance committee that's overseeing the investments. In the past, you may have had a relationship with your advisor where the advisor came in on a quarterly basis, said, here's how we're doing, this is the strategy, this is what we recommend. The committee says, it's 6 weeks after the end of the quarter, you're recommending now that we cut back our allocation to stocks by 5%. I wish we would have done this, 6 weeks ago. And as a consequence, the committees are coming to a point where they're saying, look, we've hired you as our experts rather than you bring to us every single, recommendation for us to consider and then vote upon. We within the confines of the policy, we're giving you the discretion to hire and fire managers, change the asset allocation within their parameters, and understanding that you're going to be held to and evaluated on the basis of results. So increasingly, the investment advisor in this particular chart is also acting as the investment manager. Examples of some of the fiduciaries, don't need to spend a lot of time talking about this, but these are some of the funds that come into play. Again, the kinds of parties that can and are deemed as fiduciaries. The general precepts from the FI 360 self-audit, actually I'm going to skip ahead one slide to talk about the quality management system, and that's what this is. It was designed by FI 360 to provide a global fiduciary standard of excellence. Again, it followed, it does meet all of the applicable rules and regulations that are currently in place. It is reviewed on a periodic basis and is updated as necessary according to regulatory changes. It's been reviewed by the AICPA, and it's based on underlying code, rules, regulations, and an increasing amount of case law. Back to the previous slide, the general principles of FI 360. Again, I'm not going to go through each of these bullet points for the sake of time, but it begins with the requirement that you be aware of applicable standards, laws, trust provisions, that you diversify assets, as Rory discussed earlier, that there be a written investment policy statement in place. A footnote on that, it's important that the policy statement be reviewed on a regular basis. We are working with an organization that actually came to us, said we think we need some assistance with our portfolio. We asked them to see a copy of their investment policy statement, and they presented us with a one-paragraph document that was last revised in 1987. So we said, time out, we really can't do much in terms of talking about how to structure your portfolio. The first step is really to take a step back. We need to talk about investment policy. We need to clarify goals, objectives, time horizon, liquidity requirements, roles and responsibilities before we actually start to make any sort of changes here. Using prudent experts, again, that is now both permitted by and I think encouraged to a large degree by MIFA, and certainly in the case of ERISA, controlling and accounting for investment expenses, where we talked about the ongoing monitoring of your prudent experts because your investment committee or your board has delegated to an investment advisor the discretion to hire and fire managers, and even if there's not that discretion that's provided, it is still the responsibility of the organization to make sure that you're monitoring the results of your prudent experts on a regular basis. And finally, to avoid conflicts of interest and prohibited transactions, something that Rory also talked about. There's really 4 steps in the fiduciary, the self-assessment. Again, if you want additional information about this self-assessment, the template, there's a contact information on us in the handout. You can reach out to us and we can send you some additional information. But there are basically 4 precepts: organize, formalize, implement, and then monitor. I'm going to walk through at a very high level and fairly quickly the 4 precepts, and then Kenny's going to actually take one of the precepts and drill down to sort of what we call a deep dive to give you some idea of the level of specificity that a fiduciary, one of these fiduciary audits involves. So under the first section, the first standard is organize. And you'll see under this standard there are 5 basic requirements, beginning with our investments managed in accordance with applicable laws, trust documents, written investment policy statement. That's first and foremost. Are the roles and responsibilities of all parties clearly defined, documented, and acknowledged? Is there can you demonstrate that there's no self-dealing going on with regard to the fund or regard to the plan? Are your service contracts in writing? Do you have a written agreement with your investment advisor, your consultant, that explains exactly what they're going to do and how they're going to be compensated, and to make sure that there are no conflicts as part of that particular agreement? And finally, are the assets within the if the assets are within the jurisdiction of appropriate courts? are you protected against theft and embezzlement? So, Jeff, I'll give you a shout out to your program coming up next month rather, on preventing theft and embezzlement. It also relates to, I think, Shannon, your comments that you'll have about what fiduciaries need to be doing to make sure that your assets are safe from those sorts of activities. The second precept of the FI 360, again, I'm covering this extremely quickly, is to formalize. Have you as an organization, has your committee, has your board of directors identified the time horizon for your fund? This would relate more to an endowment or your reserve funds, but have you, actually set forth a specific time horizon? Have you worked to develop an appropriate, acceptable risk tolerance? Certainly risk is on everyone's mind today, again, based on the volatility we see in the financial markets. It's still interesting to me that when we go in and talk with prospective clients or we're in a finals presentation, how the committee wants to jump to one question, and that is, well, what have your returns been over the past, 5 years, 10 years, whatever? Very little discussion around risk. And we think, again, that when we're talking about nonprofit assets, ERISA, defined benefit plans specifically, and/or endowments, that really managing risk is as important, if not more important, than seeking to maximize returns. Again, are the selected asset classes that you have selected consistent with your risk tolerance, with your return objectives, with your liquidity needs, and with your time horizon? Do you have the IPS in place? Again, this talks about the need for that written document that it be revisited on a regular basis. And does the IPS reflect? And this is, boy, I tell you, this is a whole separate subject, but the whole issue of socially responsible investing. Some of you in the room may work for groups where you have socially responsible screens in place. This is something that's been around for a long time, probably started with apartheid, has now expanded, continues to grow, evolve. But if your organization has certain mission, purposes, goals and objectives, social initiatives or screens or things that you don't want to invest in, is that reflected in your policy document, and is that reflected really in your portfolio structure? The third element of the fiduciary audit is implementation, where you or your advisor would look to make sure that the strategy is being implemented in accordance with, within a reasonable level of prudence. Do you have safe harbor provisions? Are they being followed if they're elected? This is an ERISA-related criteria. Are the investment vehicles appropriate for the size of the portfolio? Rory talked about alternative investments, and a growing number of nonprofits are looking at and including alternatives in their portfolios. But if you've got a portfolio that's $200,000, alternatives may just not be appropriate for you based on the size, the scale, the sophistication, the entry requirements for particular asset managers or asset classes. And finally, are you following some sort of a process, due diligence process, when it comes to selecting your providers, in reviewing their performance? And this would also include your custodian. Again, it doesn't have to be something that's long and comprehensive, but it has to be, it should be in writing that you've documented the process by which you've selected managers. We're all aware, I'm involved with several nonprofit boards. I sit on investment committees and the boards of directors, and there are decisions that are often made that might be made for reasons other than, what's the best decision based on all the facts. We have to be careful about those things, more and more careful today than ever before, and that needs to be, again, documented, how we're making decisions. And the final step, and this is the last slide that I'm going to talk about before I turn it over to Ken, is monitoring. Are you receiving periodic reports that look at the performance of your portfolio against your investment objectives? Are you looking at the performance of the sub-managers, of each manager against their benchmarks, their peer groups? and the portfolio against the objectives that are established in the policy. Are you, as part of that process, are you looking at your managers to make sure that there's been no change in the organization, or that the team that was managing your large cap value fund has left and gone to an entirely different firm? You need to be aware of those kinds of things. And is there a process in place to be able to monitor those sorts of events? Are there procedures in place to make sure you're getting a decent execution on your trades and transactions? Proxy voting, make sure that that's being done in a prudent way. Again, Roy talked about the importance of understanding fees. Fees need to be low, but they need to be reasonable, and they need to be in accordance with the services that you're receiving. So it's not, I would suggest to my friend Rory, it's not always, we've got to drive costs to the lowest possible level, but we have to be able to monitor our costs. We have to be able to justify the costs, make sure that they're reasonable given the services that we're expecting from our managers or service providers. Again, are there any finder's fees affiliated with any of the investment options that are being made in the portfolio, or any finder's fees that might be made in conjunction with those that we're contemplating? This has become a big issue in the state of California, where people have lost jobs. The California Retirement, the CalPERS, the largest single fund in the United States, was using intermediaries in many cases, or intermediaries were being paid by the asset management firms to get favorable a spot at the table and to get business by the California Retirement Plan, and that's led to numerous lawsuits and terminations. And then finally, is there a process? Do you have something in the documents that you are, you're meeting your fiduciary responsibilities? Again, part of it has to do with your policy, part of it has to do with the process, part of it has to do with the documentation that you maintain in your files. So again, I've covered this very quickly, the four general principles. Kenny Lowe's going to come up and take just 5 or 6 minutes and talk about one of those standards and take a deep dive.
Yeah, thanks, Rob. As Rob mentioned, there are 22 practices involved in the quality management system. Within each of those practices, there's a variety of criteria that you need to make sure that you're meeting to make sure that you're following the fiduciary quality management system. We decided to take a deep dive just into one of these due to time constraints, and I think one of the items that we feel is probably the most important, and it's been alluded to throughout, is the investment policy statement. So we're going to go into that real quickly. I know we don't have a ton of time, and Shannon's got some good information for you regarding retirement plans. I know there's a question specifically about that. But within the fiduciary quality management system, when you're looking at the investment policy statement, there's a variety of criteria you want to look at.
It's the other arrow, right arrow. Here you go.
Oh, no, that was it. This is it. Okay. Great. Yeah. So, number one, does the IPS define the duties and responsibilities of all parties involved? Okay, sure. Now, these are different for retirement plans versus the investment assets of the nonprofit organization. We've come across some nonprofits where they've used very similar policies that they're using on their investments for the retirement plan, but you want to focus on some other items in the retirement plan. You want to obviously make sure it's compliant with ERISA. You want to look at a couple of areas related to employee communication, 404C regulation. There's some other items you want to look at as far as fee transparency. So you want to make sure that you distinguish between the investment policy for the retirement plan versus the investment policy for your investment assets, your endowments, foundations, reserve funds, what have you. And that goes along with the duties and responsibilities. There's different parties involved in each of those policies. You've got the committee. There may be different committees for the retirement plan versus the investment assets. There may be a benefits committee. Those responsibilities need to be outlined. You've got the investment advisor's responsibilities, investment manager's responsibilities. You've got the custodian. In the case of retirement plans, you have a record keeper that you're involved with that has a whole different host of responsibilities. So within the investment policy, it's important that those roles and responsibilities are outlined for all parties involved, and that all parties involved are aware of those responsibilities, are provided with a copy of the policy, and that you've documented that they have been provided with that. Focusing on the risk, return, time horizon, and cash flow parameters. Again, these are going to be different depending on whether it's a retirement plan related or investment related, but the same principles apply. You want to make sure that you've established, what a typical investment menu would look like, what asset classes, what investment categories you want to include, what your target allocation would be within each of those asset classes, what a maximum might be, what a minimum might be. And then you also want to look at how often you're going to need the money. You have different needs for different portfolios. You may have a short-term portfolio that's going to be pulled from more often, so the assets within that portfolio need to be structured differently, and that should be outlined in your investment policy. Due diligence criteria and monitoring criteria, I think both Rory and Rob touched on this, so I won't go into this too much, but you do need to distinguish between the quantitative criteria that you're looking at on a periodic basis, such as risk-adjusted performance, manager tenure, expenses, and so forth, but there's also qualitative style consistency, the management team, the stability of the organization that's investing your funds. You need to look at all those items. You need to be monitoring them on a periodic basis. So you need to have all of that outlined in your policy. And then finally, expenses. And this has especially gained a lot of attention in the retirement plan world. There's a whole host of regulations and requirements that either recently came out or are getting ready to come out. I know Shannon will go into that in more detail, that address fees, fee transparency, and that's aimed at making sure that you as a fiduciary have the information that you need to meet your responsibilities, to evaluate the services you're being provided, to have that in the investment policy, and to be following a prudent process. At the end of the day, it's really all about documenting. It's very important that you have a policy in place and that you're following the policy, but you also need to document anytime you are following any of those procedures, any of your monitoring reports, any of your committee meeting minutes. All of that should be documented, kept in a centralized place. I know that with respect to retirement plans, the DOL is really ramping up their auditing of retirement plans. They've hired a ton of auditors in the past couple of years, I think something like 1,000 auditors, to specifically focus on auditing retirement plans. Okay, here are a couple other things you might want to consider with respect to your investment policy. You need to, it's kind of a more art than science with the investment policy. You want to make sure that it has the detail that's necessary so that all the folks, all the different parties that are involved with the management of your funds have the detail that they need to make sure that they're fulfilling their duties with respect to the investments or with respect to the retirement plan. But you want it to be flexible enough so that it can be implemented, that it doesn't need to be changed frequently, that you're not having to go through on a quarterly basis and adjust the policy because it's so rigid. Typically, you'd review a policy on an annual basis. It is common, but you don't want to have to continually have to make edits. There is a way to combat certain areas where edits are required often, and that's just to include it as an addendum. So certain areas where you know it's going to change a lot, whether it be the committee, the board members, whether or not it's the asset classes that are used that are being made available, what benchmarks you're using to measure performance. All of that can be included in the addendum, as well as the capital market assumptions. So this is one more slide before I turn it over to Shannon, and we're running a little short on time. But if you do it the right way, and if you construct your investment policy in a clear and effective way, there's a lot of benefits that you can gain from it. Avoiding unnecessary difference of opinion, resulting conflicts. I know a lot of you work with, fairly sophisticated investment committees and very strong personalities that you're having to manage all of those personalities and keep them focused. If you have an effective investment policy that you can turn to when someone says, hey, I heard that, the market, it's about to, enter some really unstable times, it's very volatile, I say we move it all, move everything to cash. If you have a policy that you can go back on that says, no, we've got these target allocations in place, we've got controls in place to determine whether or not it's necessary to make a change. And we have a process that we're following, we're monitoring it, here's all the documentation. I think that really helps a lot of organizations deal with the investment committee dynamic and strong personalities. And then finally, it creates continuity. As fiduciaries change over time, investment committees change. This is a living document that you can pass on to the new fiduciaries. And if you have a very robust investment policy that outlines everything, it really helps with the onboarding process for new committee members. I'm going to end there and move to Shannon. She's going to cover fiduciary responsibility with respect to retirement plans and her unique perspective working on a lot of audits for retirement plans and some of the things that she's seen.
Hi there. As Jeff said, I'm a manager at Larson Allen. I specialize in auditing of employee benefit plans, so I'm sure a lot of you have gone through some of these audits and had a great time with them. But so a lot of what these guys covered with regard to fiduciary duties and issues flows down to the plan, but I just want to quickly go over some of the highlights and the important features of this for your ERISA plans. First of all, just to start off, the functions that create a fiduciary. So what does the Department of Labor look at as considering who is a fiduciary? What functions are they performing? The first one is exercising discretionary authority or control over the management of the plan and the assets, rendering investment advice for a fee, or discretionary authority over the control of the administration of the plan. So do you have authority over, any amendments being made to the plan, choosing and hiring service providers, those kinds of things? So who does the Department of Labor consider a fiduciary? Plan trustees, these are typically named individuals in the legal plan document. Custodians who are holding the assets of the plan, investment advisors, plan administrator, or any individual exercising discretion in the administration of the plan. These can be unnamed individuals as well. So you can have somebody, such as human resources or company executives making these decisions that are then being held out as fiduciaries. A plan administrative committee, if there is one assigned, and then the board of directors who would assign that committee over the plan.
Can I ask a question?
Sure.
That last slide, were those ords or ads? In other words, if you had a let's say a 401k committee, and they have all the responsibility for taking this, that, and the other stuff, then is there any liability to these other groups? Can you repeat the question? The board of directors or whoever?
Oh, sure. So the question was, if there is a committee assigned, if it then flows, if there's also fiduciary responsibility on the board of directors side?
Or the president
or the executive of the company. That would be, I guess it depends. It would be, if you have an executive who has any authority to make decisions with regard to the plan, they can be held out, or the directors that are appointing the committee members.
So what can one do so that you actually know who the fiduciary is, rather than a bunch of these people who might be the fiduciary?
A lot of times, well, you'll see that with regard to the actual trustees of the plan are usually named in the document, but it really depends on who's being held out as making decisions over plan processes. And
being a fiduciary is in a lot of ways a functional test. You could have multiple fiduciaries for a plan. In certain cases, when using an investment manager, you could actually delegate a very narrow fiduciary role to a third party and eliminate some responsibility for, like, let's say, the investment management, the investment selection, but you can't relieve yourself of the fiduciary responsibility of selecting that person.
So, for example, an HR staff might have sort of ministerial functions, but not a whole lot of discretion. Would they be fiduciaries?
Typically, it's my understanding, I'm not an ERISA expert, but it's typically my understanding that people who are just doing ministerial functions wouldn't typically be a fiduciary. But we can get back to you on that. I'm not, I wouldn't hold myself out as an ERISA expert on that, but we can follow up with that if you want.
Yeah, and I would also add that one of the items you mentioned about trying to eliminate some of the fiduciary responsibility or clarify a little bit, there is, I think as Lori alluded to, there's different levels of ERISA advisors that you can obtain. One's a 338 regulation, which is growing in popularity. And if you have somebody that's stated that they are a 338 investment manager, they are liable for the investments that are included in the investment menu. So that's one way to absolve some of that liability that various fiduciaries may have. And the other item I would point out is that even if you have someone that's a named fiduciary, it does come down to how they exercise, what control are they involved with decisions with respect to selecting the service providers. If they are, then they are a fiduciary whether they're named or not. So it's more about the activities they do and less about who they are, what their role is, what their title is in the organization.
So the 338 consultant is basically a certified expert that assumes those responsibilities for the decision.
Yeah, it's considered an investment manager that is taken, as acknowledged that they are 338, it's in writing, and they are the ones that are going to be responsible for selecting the funds in the menu. Now, that doesn't mean that you're absolved of your responsibility to make sure that you're following a prudent process in selecting that 338 manager, but they are taking responsibility over the investment menu decisions.
Exactly. All right. Let's see. So I'll just go over this one real quick. Fiduciary duties with regard to the plan is kind of similar to what we've already discussed. You would want to act solely in the interests of the plan participants and those beneficiaries. Ensure plan assets are held exclusively for the payment of plan benefits and reasonable plan expenses, which we'll get into a little bit later. And determining fees for services between a plan and a party in interest are reasonable. So this would be your trustees. If that is a third party, a lot of times the custodian is also contracted to be trustee, investment advisor, or your record keeper. So how can you limit your liability as a fiduciary? The first thing, which is kind of a repeat of what everyone has gone over, is demonstrate that you've carried out this responsibility. Document it. Keep documentation. Like they were saying, the Department of Labor is coming out. They're doing these audits. They want to see that documentation that somebody is looking at these plans and monitoring all aspects of them. So examples of this could be a board of director or committee minutes that discuss the plan. Having policies and procedures in place surrounding the plan. A lot of times it's a great idea to have an investment policy that's separate from the organization's investment policy, just to kind of outline the types of investments that you are offering to your plan participants. Give participants control over the investments that they can choose from. So offer a variety of investments, so then the burden's kind of on them to decide where they want their money to go. It doesn't relieve you of the responsibilities if some of those options aren't quite reasonable, but it helps to kind of mitigate that risk. Hire service providers to carry out fiduciary functions. A lot of plans, an investment advisor will be hired because they can help select the proper investments. They're monitoring those kinds of things a little bit better than the typical plan sponsor wishes to or can do in that detail. Monitor your service providers. Just because you have service providers and they are held out as experts in the field doesn't mean that they shouldn't be watched as well. Review their performance. read the reports that they're providing to you, check the fees that they're charging. Are they reasonable, reasonable plan expenses? Ask about their policies and procedures, and then follow up on participant complaints on any of the service providers that are being used. And then last, you would want to maintain proper fidelity bonding over the plan. The Department of Labor requires that this fidelity bond would cover at least 10% of the beginning asset balance, but does not need to be any more than $500,000. And then also ensure that there's no deductible on that plan. I see that once in a while. Now, one of the hot topics right now with regard to benefit plans is the Department of Labor's, the regulation that just came out, 408B2 disclosure rules. These guys alluded a little bit to that. It's just increasing the transparency of the fees that are being paid out of plan assets and determining, are these reasonable? And so what these rules are doing is trying to help fiduciaries in getting the proper information to determine if these fees are reasonable. Sometimes they may be hidden or not explicitly stated in there and kind of netted with the income of that fund. And so now that's kind of being brought to the forefront and helping those fiduciaries understand what's being paid out of the plan and if they're holding the right types of investments for the participants. And then these regulations do apply to ERISA plans only, defined contribution, defined benefit plans. Health and welfare and non-ERISA plans are exempt from these regulations. Trying to avoid a little bit of repeats of what we've already discussed here. So these, I'll move on here. The disclosure rules, a lot of what these are requiring are already happening in some of these benefit plans out there. However, it might just add to the detail that is prudent. So, for instance, general plan information is provided to participants, but it's just kind of going into a little bit more detail on that. And like we said, administrative expense information, making participants aware. And I haven't seen yet what investment advisors are providing to their clients with regard to these, so you guys can jump in whenever if you have anything. But I know it will be a lot more information going to plan sponsors, fiduciaries, and participants with what types of fees are being paid and why they're being paid and things like that. Performance data, benchmarking data, fee and expense information.
Yeah, and Shannon, I would just add to that, encourage everybody to go to their service provider and say, well, can you give me a sample of what you guys are going to be providing as far as 408B2? They should have something, available at this point. They should be working on it, and although they pushed the dates back a couple times now for when it was going to be effective, most service providers have something in place that they can show you.
Now, what are the responsibilities of the plan sponsor with regard to these transparency of fees? You would want to consider how these new disclosures are going to affect your plan. Just like he said, inquire of your service providers regarding their process to comply with these new requirements. Review the disclosures and determine that they satisfy the requirements. Determine whether the compensation paid to service providers is reasonable based on the services rendered. This is one thing that typically you'd want to review these types of things annually. And then also it's a good idea to benchmark your service providers against other service providers maybe every few years or so. And then as always, document this process so that you have support for these procedures and controls in place. Any questions? I think that pretty much covers the...
Anyone have any questions for Shannon or for any of our panelists on anything that we've talked about here today? Yeah.
What's the responsibility or obligation to report or fully disclose
Whoever wants to take this, be sure to repeat the question.
Let me take a stab at that. I think the question was, what responsibility does an organization have to report back to the members of that organization with regard to losses in the investment portfolio losses or performance? I don't think there's anything specific in law or in a MIFA that specifies what organizations have to do with regard to information provided to donors. I will tell you that there's more and more scrutiny around, on the part of the membership wanting to know, what's happening at the fund level. And I think we've seen an increasing number of our clients that are providing, not only as part of their annual report, which typically will show on an aggregate level change in the portfolio value, but will provide on an as needed or as requested basis. They'll have on their website, if you'd like information about our portfolio, the way it's structured, contact us for information. But there's nothing that I'm aware of in terms of a specific rule or regulation that requires that information be provided. But there is greater scrutiny around that, and there's greater attention being placed on that, both on the part of the donors as well as the organizations.
I'm not aware. You went?
No. Yeah, question right here.
Yeah, reference is made to finder's fees, and I take it that maybe they're a no-no in the nonprofit world. My question.
What, say the question again?
Are finder's fees a no-no in the nonprofit world?
Are finder's fees long only?
No. Are finder's fees a no-no in the nonprofit?
Oh, are they a no-no in the nonprofit world?
No.
I'm sorry.
That's okay.
Right, did I get that?
Huh? We're for those of you that are on the call, we're looking amongst ourselves as to who's going to jump in and answer the question. I'll take a chance. I'll take a stab at it. It's not that finder's fees are by law precluded, but I think if there's a finder's fee that's being paid, it needs to be disclosed. It needs to be disclosed in advance. The finder's fee needs to be understood by the organization. And it needs to be taken into account as any sort of decision is made on, whether to engage a particular manager. But I'm not aware of a specific.
I'm not aware. I think you typically have a finder's fees arrangement. There are certain other rules related to, let's say, investment of government-related funds or things like that are separate, right? Local level rules you need to think about. But from the nonprofit standpoint, or any other investment standpoint, it's a question of disclosure, it's a question of consideration, it's a question of whether or not it's reasonable to pay it. What you found, and you saw that in New York, you had issues of interpositioning, right? People would sort of this finder would do nothing. Okay, from a regulatory standpoint, the issue is if you're going to get paid, you need to get paid for doing something, right? You can't just create a broker deal or get paid a fee for just making an introduction when you didn't really do anything, right? And that was the issue. That was, I think it was Dick Morris and a couple other guys in New York and Connecticut where they were being investigated for that. And then people in the plan who were involved, the question is whether or not you were sort of skirting your fiduciary obligations to sort of gain favors with some of your friends. And that's sort of where you've seen much of the emphasis and scrutiny.
Yeah, up in the back of the room there.
Uh-huh.
And then process to review your process. So the question is there kind of an infinite regressor where you need to have a process to review the process?
It never ends. Well, I think this goes to, I think Rob was talking about. This is a question of, go into a little bit more detail about the process of having a process and reviewing a process and all that, right? I think this goes to what Rob was saying. At the end of the year, okay, you have your investment policy statement, or you have, certain considerations, and you have defined roles and responsibilities, right? And I think that where some don't pay as much attention is on that periodic review on whether or not that roadmap or whether or not those roles and responsibilities defined are working. And when I say have a process to review your process, it's almost at the end of the day, after you're at the end of your investment policy saying we're going to periodically, we're going to review it. We're going to review it at least annually to see whether or not it's working, to see whether or not if we delegate to a board or these two individuals, the CFO and the controller, the responsibility for making certain decisions, are they making those decisions? If we identify specific information that they're supposed to include or time or factors that might trigger an ad hoc review, did any of these occur during the year? And if that's not working, I think of it as do what you say and say what you do. Don't have policies that are out there that someone can come in and audit that you're just not consistently applying.
Well, you mentioned what sounds like a key word. Is it somehow obligatory or at least approved to have an audit, something less than a formal audit periodically from outside party audit that you're doing?
Well, so the question was whether or not there's something that makes it obligatory to have something less than a formal audit or a formal audit, some kind of audit of some sort. I think it becomes incumbent upon you, if you want to show that you effectively discharge your fiduciary responsibility and you want to show that you exercise reasonable care, that it be my own personal viewpoint. It's not set out in a rule anywhere, it's not explicitly required, but it would become incumbent upon you to have some process. I think it is best practice to document that review. I think it would be best practice to review it at least annually, and it would be best practice to include the notion of a review, at least on an ad hoc basis, if certain things happened over the course of the year, so that you're not sitting idly by. I mean, to go to your question about reporting, right, the whole, from an investment side or even, other responsibilities of fiduciaries of an organization, you can't just sit idly by. You have to be proactive. You have a real responsibility to try to implement the purpose of the donation, of the endowment. Okay, and you can't just sit there and wake up 12 months later and say, oh, our endowment shrunk by 50%, okay, because you could be negligent in not doing anything. And so you have to be proactive. And so it's good to have formal factors that would trigger ad hoc reviews. It is good to have some formal criteria to review every year.
Okay, one last question. Yeah.
From your experience, and whoever wants to handle this, have you noticed a lot of fear in the organization so that they're going forward very conservative assets like CDs and things like that? I mean, because, if I'm the CFO of a nonprofit, maybe I'll just do that, and even though we have low returns, just to avoid any liabilities, exposure, or losing their money. Is that something that's happening, or is that what is happening?
Yeah, to repeat the question, are we seeing any sort of trend in changing investments, moving to much more conservative instruments such as certificates, CDs, just to avoid any sort of market volatility or the potential of loss? I would say that we really don't see that happening. There's a lot of talk about that, particularly during periods of market volatility, where committees will say, well, maybe we should become more conservative at this point. One of the challenges, however, particularly over the last several years, has been as with the economic downturn, more and more organizations are turning to their reserves or reserve funds, maybe as a source to supplement their operating income. Secondly, if you're running an endowment, by definition, you've probably got some sort of regular spending out of that endowment, might be 4 or 5%. And statistically, it can be demonstrated that if you're spending 4 or 5% of the corpus on an annual basis and investing in CDs at 1%, you're eroding principal, which would not be consistent with fiduciary prudence. So while intuitively we can certainly understand that organizations or CFOs might say, well, let's just put everything in CDs. It really is dependent upon the purpose of the fund. If there's any sort of growth requirement of the fund, if it's a building fund and you're trying to grow it from point A to point B, Chances are you're not going to be able to do that with CDs, particularly when you take into account inflation. So we really haven't seen, seen that trend. If anything, it's been more the opposite, where organizations are realizing we've got these embedded spending requirements or financial needs. We're going to have to take the risks as much as we might not like them and as much as we might not like the volatility that we're living through right now.
I mean, I'll tell you from a legal side, that's the investment side. I'm seeing two trends more so. I think the first is more organizations are really focusing on what their investment policy statements really say. I think it's been really informal as to how things have been decided over time, and I think more people are calling with questions about who should be making this decision, where should we write this, and they're really looking close. Rob gave the great example about the one group who had the one paragraph. I mean, I looked at one where I don't know, it was some agglomeration of many things taken off the internet, but just didn't really make sense. So they were really focusing on really setting a real solid foundation and roadmap. That's the first thing. The second thing that we're seeing, it's sort of a byproduct of the fact that the market has had so much volatility and endowments have lost so much money. And then I think there are a lot of organizations that are looking at merging different pools to try to more effectively manage the pools. And in connection with that, I think one of the holes you're seeing is they're going back and when you're trying to help them analyze how best to put them together and justify it if you're going to have notice to the Attorney General, is to better understand the purpose. And then you go back and you say, well, where's the gift instrument? And I think a lot of people are now going back and trying to get their arms around all the gift instruments that they have to better understand what the purposes are.
Okay. With that, we're a little bit after 2 o'clock Eastern. I want to thank our panelists very much for a terrific presentation. Thank you all for coming here in person in D.C. and participating on the phone. And please be sure to join us again for our next seminar and webinar on December 6th regarding detecting and preventing fraud and embezzlement in your nonprofit organization. Thank you very much.